Good afternoon, traders. Today is an important topic, re-entry technique and how to not turn a trading idea into a tilt. This is one of the reasons why traders lose money. This is a struggle for your idea when the instrument does not seem to change the price of what is happening, but knocks out short stops. There are the moments when tilt occurs. Let me show you my screen. Okay, and here is an example. Explicit stop after a local trend. Here, you see. The instrument approaches the level one time and tests again. False breakout. You see it. There is an idea. There is a clear level. There is even a false breakout that reinforces this situation. And it would seem that everything was done right. But stop loss order is touched. But there is again a return to the level. Involuntarily, there is a strong desire to quickly re-enter, the desire not to miss this opportunity. And again, they knocked out this stop. You see, you entered here, here, and once again. On the third attempt, the instrument still writes, but the question is that the majority will simply not have enough nerves. Someone will already doubt and will not reopen. I will say more. Such a cut level can be much longer in time. And these will be all new losses, reaching already substantial proportions. And now just provide statistics when every time you try to prove and defend your idea in such a low volatility market. Look here. These are real statistics on similar volatility. A trader often gets 5 till 7 losses in a row and then takes a profit 3 to 1. What then with your statistics? With 20% of positive transactions, 1 and 5, 20%, and 1% risk per deal, and a potential of 3 to 1, you leave your deposit in the market for almost a year. And you have a decision to increase the potential for risk, but here it will already depend on stop and volatility. Will the instrument be able to achieve its goal in most cases due to its natural volatility, or increase the percentage of positive transactions? And this is experience and skill. And it is desirable that both ratios grow, and the percentage of positive transactions and the coefficient of potential for risk. Let me explain with an example what it means enough by a natural volatility and how to relate it to the risk potential. On this example, everything seems to be simple. Level, holding level, stop, consolidation, sell short, and take 7 to 1 profit per risk. If we again return to statistics and lay risks already when levels saw up, so with reopens and losses, it seems 7-to-1 potential for risk is enough. That seems to be simple to increase the potential for risk, and the problem of positive transactions has been resolved. Is it true? And in this example, you see that the instrument clearly realized its average statistical potential. 103, 103. Here was entering point. That is exactly more than 60% of cases. Many use ATR indicators. But this is a simplified calculation of volatility, and you need to be able to work with it and look at the ATR statistics even then. Here, half an ATR moved. It is not necessary to fix immediately after the passage of natural volatility. Here you see natural volatility, 135, and this volatility from high to low here. But instrument goes down. That is why experience plays a big role in making decisions and understanding prices. In this case, the instrument stopped after passing through its usual volatility. But buyers are not visible. The price is growing passively. Therefore, in this case, the position is held further. But that would make the majority when the task is to pick 7-to-1. You can show this statistic. You can say you need to have 7-per-1, and majority will realize such as in this example. Why? Because the majority have had a fear of a short stop and do it too much. You see here, let me explain. You see here we have a level, once again level, and majority will understand this situation as a false break down. So enter here, and where you can hold your stop loss. Of course, stop loss maybe will be here, because short stop loss can be touched by usual volatility. So many people think that it is necessary to work with large stops, and this is the solution to the problem, so that you do not have a stop loss trade taken away. But then you get another problem with big stop losses. The market moves in 80% till 90% of cases as a part of its natural volatility. this one, natural volatility, you see, or ATR. And such decisions will leave the percentage of positive transaction in less than 10% of cases. We make allowances for erroneous transactions, and your percentage of positive transactions drops to 5%. So you see at this chart, if you use large stop losses, such here or maybe here, you need to achieve aim near 46.70. But you see usual volatility around 135. Monthly volatility may be much greater or weekly, but it's low chances to trade intraday and try to realize such a big take profit. After that, we hear smart statements that 5-to-1 or 10-to-1 profit risk is impossible. Yes, it is impossible if you do not understand the tool with which you work and the basic principles of trading with probability. Now, let's see what happens if your percentage of positive transactions drops to 5%. You should already receive potential in transactions of more than 20 per one. Is this realistic? Well, there are similar movements. Everything is real. But are you ready to endure drawdowns of 10 till 50 or maybe 20 transactions in a row and more before such a trend movement takes place? I'm not understand. I'm not believing it because it's hard. Maybe it's your niche. And as for the reopens, here is another example of how a level can be sown and how long this can take. But if you look at a reasonable stop here, like an example with oil, if you enter here, and look at volatility in this instrument, then this deal will simply disappear by itself. And here is another example from a real deal that just closed today. I especially show fresh deals. And you know, many will say, so when it was, if you show old one. Although the main is principle and not when the transaction was completed. It's not so important. But nonetheless, here the second reopen is enough to get into the deal clearly if you firstly get here. There is a stop, there is a retest, there is one false breakdown, breakout, and second false breakout, and I entered the position. I opened this position. And I can say that this is an aggressive entry. I had confidence in this tool. The fundamental was not in favor of the index. The depletion of several days of growth. You see, this depletion. And a return to average volatility was highly likely. But for beginners, I would not recommend such an aggressive approach. Yes, many movements can be missed, but above all in the quality of transactions. And every time, after 2, 3 losses, I return to the conservative approach. How can reopens can be reduced to conservatism? Just bide your time. The longer the consolidation, the greater the chances of a strong movement, the greater the chances of getting your math at risk. Yes, the longer the consolidation, the fewer transactions and the more disciplines suffer. Well, you have to work on yourself or find your niche by nature. In these transaction, I manage to pick up more than 10 per one. More calmly, I could pick up 77.99 first level, or maybe here, just enough in potential. But again, there was confidence in the trade and that it would go to 77.62. It is possible that I could wait a little lower. But I also have emotions. I am not a robot, but I grow about myself. If 7 years ago I could hardly take 3 to 1 profit per risk, today it is very real task to take more than 7 or 10 per one or maybe more. But more for today is already becoming scarce for my accumulated profit. But I adhere to statistics, and this is the first and foremost. Let's go back to the numbers and talk about impossibility of doing 10 to 1, as many tend to say, like low volatility. You saw, I have shown more than once deals at the question is the correct assessment of this volatility. In this trade, we see that the volatility is 113. And that's why I think that in this transaction, it was still possible to sit on. Level has not been tested yet, and volatility allows 113. But for the remaining 2 to 1 risk profit, it's 10 to 1 and remaining 2 to 1. So for the remaining 2 to 1 with accumulated profit of 10 to 1, I decided to roll fishing rods. I think you understand me why. Well, I hope you learned a lot of new and useful from this webinar, or old and useful. In any case, repetition is the mother of learning. It is important to calculate your reopens. How many times? How many risks? Under what conditions? Next, check all these on statistics. What is the percentage of positive trades? Are your entry points correct and give a mathematical advantage? Or do you trade from weak levels? What potential do you take? What is the size of the stop loss? And is it possible to take more potential? Trading is not an easy job. You need to work hard on the open positions technique. You need to know how to work with numbers and probability. I'm trying to give you a vector of development. I hope that I was able to help you. I will be glad to the likes in gratitude for this video. See you soon again. All the best to you and success.